US inflation is moving at its fastest rate in 30 years, leading to price increases to households for everything from groceries to cars. Breaking this all down for us and what it all means, Evan Lucas, he is the Chief Market Strategist at InvestSMART. Evan, so I'm looking at those numbers this morning, 31 years. It's the highest it's been. What does that mean in simple terms for those who don't follow finances as closely as you do?
Yeah, and I think that's probably a good question from the point of view that we sometimes hear about this word inflation and don't really sort of gauge what that overall means to your cost. Just to put it into perspective, in the US at the moment, headline inflation, which is the price that you pay for the goods that you have, has risen by 6.2% from this time last year to where we are now. But to put it in other aspects, fuel, for instance, at the Bowser in the US has risen 30% in 5 months. So the cost of petrol that the US is having has increased about $3.21 US a gallon in the last month alone, and it's up around about $10.50 a gallon in the last 5 months. So you can't not feel that. That means that the prices that you have to also, with things like meat, fish, poultry in the US, is also up around about sort of 14 to 15% in the last 2 months. So your staples, the stuff that actually we call essentials, which is food, fuel, health, education, and also movement, those are the essentials, the basic sort of numbers that we always have to do every day. Those kinds of price increases means that you all of a sudden have to find a bit more to pay your home loan. You have to find a bit more to do your everyday living that you want to do outside of those staples. And it therefore makes you rein in the spending that you have. So
if your wage isn't rising, you're feeling the squeeze.
Yeah. Correct. And that's the other part of this, is that wages in the US, they are moving at a fairly decent clip, but not at the same level to keep up with what's going on in inflation. And it is starting to actually have a genuine effect on the economy. It's having an effect in the politics, and now it's also affecting markets as well.
Yeah, all of a sudden it comes down to the economy for Joe Biden, which will be interesting heading into the midterms next year. Meanwhile, over here, how can that affect us here, Evan?
So we're already starting to see that effect. So what we saw last night, US bond yields, which is the rate that the US government pays, or the cost that it has for borrowing, jumped up about 11 basis points. What it means for us here in Australia is that we know it's a similar effect here, but we sometimes forget when we talk about the RBA and the cash rate and what that might mean to your mortgage or your personal loan, etc. Private banks, your big four banks and everybody else that you borrow from, they actually don't have enough money to lend out to you and I from just getting it from retail deposits, from a term deposit. They have to go and borrow money extra in what we call the wholesale market, bond markets, etc., to actually then lend to us. If those rates start to jump up across the globe, because they can't just do it in Australia, they go across the world to do that, they're going to have to start increasing, independent of the RBA, the rate that they charge you for your mortgage, for your home loan, etc. So that is what we're already starting to see. You've actually seen Westpac increase its fixed income mortgage rates. You've seen CBA do something similar. You're also starting to see movements in other areas. Personal loans are all of a sudden getting expensive outside of the RBA. So what happens in the US hurts us here, because it means that Australian banks have to pay a higher rate to borrow, and they're going to pass it on to you and I.
And so we just talked about Americans feeling the squeeze now that inflation's at those 30-year highs. Inevitably, and more and more likely next year, right, Evan, we're going to feel the squeeze here too, because as we know, wage growth is so flat and has been for some time.
It has. And I need to point out why this is happening. It is the pandemic. There is no doubt if you look in the US, it is because of supply. So, you look at lumber, so the cost of timber, you look at things that just take your day-to-day earnings that little bit less. The demand at the moment is incredibly strong. So importing goods, clothing, etc. So apparel is really expensive at the moment. All those kinds of things, they will filter out. It just will take a significant period of time to it to come down. And we are also getting very cheap money. That's also pointed out. Demand is up because you can borrow quite cheaply. And that is the catch here. We will therefore see that squeeze. And it will be the question of whether or not we need to slow ourselves down, even with the COVID recovery still needing to take place, because we are going at such a hot rate, it does make you a little bit concerned.